Good morning, ladies and gentlemen. As you know, I've been rather preoccupied with the Irma preparations this week, so I need this run through just about as much as you do, as I have not been following the markets at all. I must say it's a very impressive storm, and as I'm recording this, it's just about to hit Key West. Let us hope that everyone there is safe and there are no casualties. Having said that, this is a chart now of the yield of the 10-year note. As you can see, it's come very, very close to this all-important trend line. We think now it's more likely to bounce back in yield towards the 213, 215, maybe even 220 area before it makes another attempt at lower yields. What is important is that both the 50-day and now the 200-day moving averages have been turned, indicating that it is very unlikely that over the course of the remainder of the year we will have significantly higher yields. It would have to be something quite dramatic for that to happen. From now on, after a small retracement, we are likely to cascade lower to below 2% for sure, probably in the 180s, just like we did here in this kind of fall, which would suggest that longer term we will be risk off. If we look at what is happening to yields in Europe, we'll see that the 2-year note has come about as far as it can come within a couple of basis points. We are now somewhere at minus 75. Draghi did nothing to change the trend here. It is unlikely that it can go much beyond, let's say, 79. So we have a 2 to 3 basis point risk for a return back up to minus 68. So that's a 3 to 1 risk reward. Definitely one of the better trades for next week would be to be short of Shats and possibly long of the bobble. The bobble, the 5-year, has quite a bit more room to come down towards minus 50. But both of these charts indicate a market which is not going anywhere in a hurry. European yields are stuck, while US yields might easily start retracing from these levels, indicating that probably the dollar is going to get a bit of a respite over the next week or so. If we look at a chart of the dollar, we will see how very, very oversold it is. And we have this trend line, which we have often mentioned, which comes in just over 90. That is the level we would love to cover shorts and look for a bounce. Now, where would the bounce take us to? Well, most probably it would take us to at least the 0.382 retracement of this whole move down. So if we try to do that, we will see what transpires. It would probably come down to about here, so the 0.382 is going to be somewhere around the 95.50 area, which in a nice ABC we can easily see, and that would be somewhere around the 116, 117 area, maybe even 115 in Euro USD, which is certainly not out of the realm of the possible. Definitely just over 90, the risk reward shifts dramatically to a higher dollar rather than a lower dollar. From a weekly chart perspective, what we mean is even more obvious. We have the same trend line, and we have these levels here which are just below 90. So this area is going to be very, very good support. We are a long way away from the moving averages, which are naturally turning over, but we certainly have room for several weeks of trading between 90 and 94 and a half, let's say. Certainly the market can remain in this kind of trading range and correct through time, if nothing else, for several weeks before the dollar continues its fall. We think this is actually only the first wave out of 5 waves, a super wave, which is going to take it way lower towards the 70 area. But here, for the time being, around 90, the risk reward we think shifts dramatically to a quick 4-5% on the upside, shake everyone out, and then go again. This is a weekly chart of gold. We are now through the Bollinger Bands, indicating that we are unlikely to remain at these levels for certainly the next 2 or 3 weeks. It would be lovely to see a shakeout of all these positions to below 1300, which is here. Just stop everyone out and then go again, or just correct through time 4 or 5 weeks at these levels before moving higher. Certainly, the dynamics of the gold market are, we think, changing. It is now going to be a buy the dip market rather than a sell the rally market. It is the first market which is significantly higher now than the day that Trump was elected, and is the market that is showing us the way towards risk off. If we start our review of the spreads, the most obvious risk off indicator, XLP, XLY, is showing us we think, a clear bottoming pattern. The moving averages are beginning to flatten out. The market could easily spend a few weeks going up and down before it decides on a clear break. It is going to, by the end of this year, it'll either have made a new low and will be in a huge risk on phase, or will have taken out the highs that we made this year, and we will be in a very, very sharp risk off phase, because these moving averages will then be starting to go upwards, and would not be surprised to end up exactly where we came from. Don't forget, this is the day of Trump's election, and the market just went hugely risk on. With gold and the dollar doing what they're doing, it would not be surprising if we started moving the other way. This chart, which is XLY, so consumer discretionary over SPY, is beginning to be troublesome. It has tried for a long time to rally, and it just can't, and it's now broken a major trend line which has held all the way since the 2009 low in the equity market. We now have new lows in XLY, SPY. If everything was right with the consumer, with the American consumer, we would not be getting XLY as the laggard in the SPY components. Very, very unlikely. This is, to us, is a very troubling chart, which will have its consequences at some stage during the course of the remainder of this year. Maybe it's too early, but the moving averages have turned. It might take another couple of weeks of sideways action before we break sharply lower, and if we do that, it will be proof that something is very badly wrong with the consumer, and as we all know, the consumer is 60% of the US economy. My mentor over 30 years ago or so always said, credit goes first. And here we are. This is HYG over TLT. So basically a pure credit spread play, junk against treasuries. Well, the best that can be said about this is that the moving averages are rolling over. It's making lower highs and lower lows. If it starts now breaking these levels that it came from in November 2017, when the risk on phase came on, it will be another indication that everything that the market has done since Trump is being unwound. And this is, to us, a very, very troubling chart. At some stage next year, we would not be surprised to see it break these lows it made in 2016 and in 2008. So, very, very troubling chart, indicating that at some stage the market will go significantly risk off. One of our old favorites, XLF, over the 3 month to 5 year yield curve. This crocodile is just as wide as it ever was. We still think that it's going to come in at some stage. This is just defying gravity. The credit, as we just saw, is getting worse and worse. The bank's funding profits are becoming less and less. It is quite obvious to us that at some stage the market will be led down by its largest sector, and that is XLF. They're still holding it up here, levitating, hoping for tax cuts, this and that. So, can this persist? Of course it can. But one day, the crocodile jaws will close, and they will close mainly through the XLF collapsing. Why do we say that? Because if we are right and there is something particularly wrong with the US consumer, it is almost likely that it will be a recessionary event. If it's a recessionary event, the yield curve between 3 months and 5 years, although it might steepen slightly, it is not going to steepen a lot, and eventually it will flatten even more. Would not be surprised to see yields flat, because it's unlikely that the Fed will go and now start cutting rates immediately. So it's unlikely to go much higher, and therefore the crocodile jaws will be closed mainly through XLF falling rather than this spread between 3 months and 5 years going higher. In terms of what we've been saying about emerging markets against SPY, well, nothing has changed. It's still in a lovely uptrend, which we think will last several years. Absolutely no reason to be worried. Neither the European markets nor the emerging markets are suffering against SPY, and we are convinced in our long-term view that other developed markets and emerging markets are a much better buy than the American market, say for XLK, over the medium to long term. If we are to be correct in our view of XLF, we have to look at a chart of XLF over SPY for confirmation. This is beginning to look very ugly. If we zoom in to this area, we shall see that it is absolutely not in a healthy position. And what is more, we know exactly where we are wrong. We have both the 200-day and the 50-day moving averages now completely turning over. This is where it came from last year. during Trump's victory. It is now lower than it was after that rally. It is making lower highs. Moving averages, as I said, turned over. We might get a bit of retracement here, but it seems to me that the moment we break that moving average, which I shall now put into here, sorry, that it's not a moving average, it's a low, and we'll try and put an alert that this market is in huge trouble, and where XLF leads, SPY will go. Having said all we've said about the spreads, we just don't think that the SPX is ready to go down yet. This is Here is a chart of the transports, and here is a chart of the SPX. It's done nothing wrong. It's done an ABC retracement. It's now completed phase 3. It's in 4. We need a higher high into the 2500s for this structure to be complete, and we think we're going to get it as an after this weekend, if Miami doesn't get hit, and all the talk about insurance companies having to liquidate hundreds and hundreds and hundreds of billions of dollars worth of equities to pay for insurance claims does not materialize, that will probably be the excuse that the market needs to do one final ramp up with risk on, as we mentioned last week. We are quite resigned to that happening, and we're not worried. In fact, we think it's going to be a huge opportunity if we go through the 2500 into the 25 teens, 20s, to get very short this market for the medium term. What we'll be looking for? We will be looking for divergences. For example, we'll be looking for a lower high in the volatility spreads. We will be looking for all sorts of, we'll be looking for a very steep VIX yield curve. We'll be looking for lower lows in the VIX, just a move into the high tens rather than a move all the way below into the nines. There will be many indicators that we'll be looking for when the market makes a higher high and divergences appear. We think that will be a very, very important inflection point in the markets. But the most important negative divergence we'll be looking for is in this chart, which is SPY TLT. If I now try to enlarge the last bit of, is it doing it? Let's have a look. I'm sorry about this. Let's see. The machine is being rather slow today. But here we are. SPY TLT has been very stubborn to go higher. It just will not go higher. If all we get when the market ramps into the 2500, if it does so, is a retest of the 50-day moving average, we are likely to then collapse, and that will be actually our main tell indicator. An SPY which is going up with TLT, which basically means that people are not convinced that this is risk on, this is just trading. People are not accepting more risk. They want to be compensated by TLT at the same rate as SPY. We just cannot work in the long term. It'll either be risk on or risk off, in which case we will either break these levels and start going up towards 2, or we will break down very quickly and go down towards the 170 level. That's a 15% move in the spread between TLT and SPY. So I would expect at least 10% of that to be due to SPY, in which case we are in for fireworks from the 2520, 2530 levels. In SPX, we could easily have a 10% move down, which would be 250 points. 250 points of, it takes you back down into the 2200s. Not out of the realm of possibility. In conclusion, our biases have not changed one iota. 5 and 10s, we are we think that the yields have now stopped falling. They're more likely to go up than down, looking for a maximum move of 5, 7, 8 basis points higher for the yield curve before, which is a healthy retracement before we are ready to start going back down. Bund and Bobble, certainly Schatz, we think, has started turning back up in yield. That's probably the best sell as opposed to Bunds and Bobble, but we would say it's Schatz followed by the Bobble followed by the Bund in terms of shorts. Commodity prices, absolutely nothing. Yes, well, we'll find out hopefully in the next couple of days whether it has anything in the tank. 25.15 to 25.45, which is basically only a percent range, is the level we would love to short, and that is the level that we'll be looking for all these divergences that I've just mentioned to complete and to confirm our view that this is about as high as the market can go. Russell 2000 below the previous high, having taken out all the stops again at 1383, will be a tell that ES and NQ can't go any higher. VIX, certainly we are buyers of any dips below 11 in the November and December contracts, so we don't want to buy in November and December below 11, but every time the front month falls below 11, we're buyers of November and December volatility. The super cycle is very much intact, out of US stocks into EM and other developed. Nothing to be said here. Dollar, from the 90-ish area, the risk reward shifts, we think, dramatically to the upside towards the 94-95 area before back down. And we still love the butterfly for the very long term. This is certainly not a position that's going to make you money in a day, in a week, or a month. This is something that's going to be very volatile because of the XLK component, but this is something that we are convinced is there for the very long term. Technology is there to stay and will have huge runs up against SPY, and we are also convinced that emerging markets are in a very long-term bull market now against the American SPY. So nothing has changed. We are watching the spreads like hawks. We are watching for negative divergences, hoping that the market makes a new high with negative divergences so that we can really short it. Thank you very much indeed, and tweet you on Monday.